Hey traders, John Howell here. In this video, I'm going to talk to you about, are we at the top in the stock market with some of these stocks like Amazon, a lot of the tech stocks, and basically a lot of the stocks in the markets. Let's get straight into it. Guys, do not place a trade based on what you see in this video because trading is risky and it can cause substantial financial loss. There is no guarantees of making money in the markets and it takes you a long time to become a really good trader. So be smart about the way you're trading. Also guys, first thing in the description, make sure you click on that. My number one chart reading and trading technique that I use every day to give me advantage in the markets. Let's get straight into it right now, guys. The thing is that we're looking at Amazon here right now, okay? So I'm not going to really talk a lot about the actual technicals of the markets, but I am going to talk to you about where we are right now in the cycle of things, okay? So we've got Amazon here. You can look at Facebook and Netflix and all these other markets, okay? Now, the thing is that I want to share with you by looking at this here is that the thing that I want to share with you is that when there is two different types of cycles that happen throughout the entire history of this land nation, okay? And let me squeeze this up here through. I want to share this with you, okay? There's two different type of cycles. There's what's called the long-term debt cycle, okay? And the long-term debt cycle, the last one was around 1937. So around 1937. Yeah, so around 1947, roughly 1950, which was just a bit. It was actually close to what's that? 2020. Yeah, so that's 70 years. All right. So 1937 to basically 47 was what they call the lost decade there. Why? Because this was also the end of the long-term debt cycle. Now, long-term debt cycle simply means that the government gets too close now that they have to start to really deleverage, and a lot of things get affected, pensions, healthcare, and so on and so forth. So the long term from right now, basically roughly 47 around there to where we are right now, say January, so it's sort of 2019. That's basically the long-term debt cycle. That's obviously the long-term debt cycle, right? Where the debt's been accumulating over time. But then so that's the long-term debt cycle. There gets to a point, now, okay, let me stop you for a minute. How do you know when you get in towards the end of the long-term debt cycle where interest rates are getting lower and lower and lower? If you look at it right now, right? Right now about 2.25, I think it is, maybe 2.5, somewhere around about there. And that's pretty close to zero, right? It's not that far from zero. And that's equilibrium for the markets. The last recession we had, I think it was obviously in 2008. Before then, right, I think the interest rates equilibrium was around 5%, and then the recession happened. So as what happens is that the closer and closer this gets to zero, that's where we start to, as we get closer and closer and closer to the zero mark, that's how you know when you're getting towards the end of the long-term debt cycle, because the government is getting tighter and tighter and tighter, getting basically squeezed out of the debt before they have to start to default or deleverage or do something with that debt instead of keep growing it. So then we also have the short-term debt cycle, which happens roughly every, say, 5, 7, maybe even 10 years, right? And that's basically 5 years up, recession, and then the market goes down. Market goes up, market goes down. Recession. Market has a boom and the market has a bust. Market has a boom, market has a bust, right? So roughly every, say, 5 to 7 years, roughly through there. Now, when this happens, right, what generally happens, the interest rate generally are inverse. So as the market's going down, as the stock market's going down, as the stock market's starting to go down, guess what ends up happening? Oh no, it's not inverse. It's the opposite. So as the stock market goes down, they actually start to drop interest rates as well too. They start to drop interest rates down through here. And so that's basically what happens, right? Is that the market goes down, they drop interest rates. Then when the market goes back up, then as it starts to get back up, then they start to rise interest rates. And then we go through a bust, and then they drop interest rates, then we go through a boom, and then they rise interest rates, and that's what generally happens, right? And so where we are right now in the cycle of things is that if you think about it, what was bullish for the stock market? Quantitative easing and 0% interest rates. What's happening right? So what's happening right now? Interest rates are going up, which is a negative on assets. and also the Fed is trying to basically reverse their balance sheet. So we have two different types of negative pressures on the markets right now. So that tells me we're at the peak of the markets, and we have done now for the last 6 months or so. So whatever market we're looking at, especially a lot of these stocks that have gone through massive booms over the last, say, 5 to 7, maybe even 10 years, when those stocks there they're probably been bought up, like JP Morgan, Amazon, a lot of these tech stocks as well too. They're probably been bought up by a lot of the government and so on and so forth. Now, because we're at that level right now, I do believe a lot of these big stocks that went through a big boom, they actually went through. They're actually now going to continue down overall for the next couple of years into a downward movement, because we get in a downturn, you get a pullback in asset prices first, then the economy. So that's what happens. And you think about it, right? If you think about this as logically, let me ask you a question. In late 2007, what were the fundamentals looking like? Pretty good, right? Low unemployment, everything seemed to be going well, and then we went through a bust, right? What did the fundamentals look like in late 2008? Pretty crap, right? But that was the time to buy. But unemployment was high. So why would you be buying there? Unemployment's high and there's no jobs and all this sort of stuff, right? So as you can see, right, a lot of the things you think about in the stock market is opposite. So, when things look really, 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 really good, that happens before bust and so on and so forth. And we go through this cycle. So right now we're getting bullish interest rates and now negative bullish interest rates, and also negative, the Fed unloading their balance sheet. We are at the top of the market, and we're gonna see a lot more selling pressure coming in now, especially throughout the rest of this year. So when we talk about like Amazon, what's happening with Amazon and all that sort of stuff, that's basically what I see right now. This is the cycle of why we are at the top of the markets.